I've spent a long time trying to say to people, just because people got burnt in 2017 doesn't mean everything repeats. I mean, in the end, Ethereum survived all of that, as did several other projects, and it's a risk curve. We're just starting a whole space. And a risk curve in financial markets, a bond investor might go to corporate credit and then go to junk bonds. Or an equity guy might go to, blue chips to tech stocks to emerging markets. It's normal. It's risk-adjusted returns. And when you go further out, in this case, it's the altcoin space, of course they're riskier. So of course you take less risk, unless you really know what you're doing and you want to commit to that. But for generally speaking, you take much less risk. And the idea is you get compensated by the returns. But you may not get, because it's risky. I mean, the word risk is a real word. It's not a one-way bet.
And how deep down that rabbit hole do you foresee yourself going beyond the, top 10 market cap
Yeah, I mean, at this stage, I don't have the bandwidth. There's way too much to learn. And I don't have the ability to understand. I'm a macro guy. I'm not a stock picker. So therefore, I'm not a token picker either. Some people do exceptionally well doing that. We're seeing that with people like Jeff Dorman at Arca and, the guys at Delphi and stuff like that. Those guys figure out the ins and outs of every single token. I'm just not that guy. So really, for me, it's the top down. Where is the space going? Where are the opportunities? Can I broadly represent that view? So I got my first job out of university was a graduate trainee at a company called Dow Jones Telerate, which was the Bloomberg of the time. And I was supporting the technical analysis product. I didn't know what technical analysis was during my economics degree at university. I think it was a half-hour lecture, which is like charts don't really work, but some people use these. So I had no idea. But then they gave me this huge book, which was John Murphy's Guide to Technical Analysis of the Futures Markets, which is now called Financial Markets. And I had to read it. And then I had to learn how to show people around this product called Teletrack, which was the charting product. I had no idea. And the first people I ended up interacting with was all of the famous prop guys from Goldman who ended up forming the Tudor office in London when they all left in the early 90s. And I had to teach them a lot of it. And then from then on, I just taught myself and realized that I was a very visual person. So it actually just helped me. Because somebody can say to me, what do you think about German bunds? I have no idea. Put the chart up, I've got an opinion. Some sort of opinion, something more informed, without knowing all of the fundamental analysis. Very helpful. And then I learned over my career that all the macro guys, because we have to look at so much stuff across so many different parts of the ecosystem, that charts is where everybody starts. You start looking for the interesting charts and thinking, now all charts are really, it's not voodoo, it's just human behavior. Just human behavior. Because basically, if you go into a crowded cinema and shout fire, 8 times out of 10, people will do the same thing. So it's probabilistic outcomes based on human behavior. And you can also see where it's come from. Were people panicky? Were people overconfident? It's not that complicated. But again, people don't like it because people want to treat everything as a science. And life is not a science, it's an art. Well, one of the great learnings for me was, I remember back in 2000, Microsoft was breaking its 50-week moving average. And I'm like, I didn't really care about moving averages. But what I realized at the time, everybody was dollar cost averaging into stuff. And basically what it meant is everybody looked back at their P&L and realized over the last year they'd lost money. That's what happens when you break the 52-week moving average, is everybody's lost money for a year. And that happened to be a psychological point where everyone's like, oh, fuck this, I'm out of this. And they sell their Microsoft shares. And then you're like, yeah, I get it. Humans are humans, we're all idiots, we do the same thing. It's absolutely sustainable for the government to do it and the central bank to keep financing it by the way that they look at the world. So they will keep doing this. This will not stop because, let's face it, I don't know what I would do being a central banker or a government official right now.
True.
You've got an economy that's totally broken. The stock market, we'll come on to that in a bit, doesn't really represent what's going on Main Street. So businesses are destroyed. If you go to the US, infrastructure is like third world. It needs to be upgraded. You need to create new jobs. If you look at the trend rate of GDP over the last 30 years, it's been falling because of demographics and debt and all. Somebody has to change that cycle, right? So are you going to just throw out the rule book, go for MMT? I get it. What else are you going to do? Austerity? Forget it.
Yeah.
So you're going to do something. So that is going to happen. And everyone's going to go, inflation, CPI is going to go up, and it's not. And the central banks are going to declare victory. And meanwhile, suddenly you'll look around and the stock market's gone up another 100%. And the price of some of the commodities have, and the price of artwork, and the price of anything with a fixed supply asset. And then you'll realize that what they're actually doing is debasing the currency. The dollar won't fall because everybody's doing it. It's the value of fiat currency overall. This is what people don't get their heads around. They keep saying the dollar's going to zero. No. The Europeans are doing the same. The Japanese are doing the same. The Brits are doing the same. The Aussies are doing. It's a massive devaluation of fiat currency. I've been fully expecting it. The US is the best performing market in the world. The technological rate of change in the US is probably faster than elsewhere right now. I mean, Asia's doing pretty well, but it's sucking in the world's capital. Also, everybody's short dollars from debts. I mean, there's 13 to 15 trillion dollars that people are short. So if you've got a cash flow squeeze going on anywhere in the world, they're scrambling to buy dollars. We've already seen that in Brazil because the virus has come back to Brazil with a vengeance. The Brazilian real is now falling every day. The dollar, it's very hard for the dollar to go down because of this dynamic. It's 88% of world trade. Everything is priced in dollars. No, because if you think about them as 30-year-olds, so they're starting to come into peak earnings now, or proper significant earnings. Equity market all-time record high valuations, fixed income market all-time record low yields, credit markets all-time record low yields, property prices all-time record highs. The exact inverse of their parents, who were the boomers. The exact inverse. The boomers basically didn't have to do anything to make money. They just had to put it anywhere. So, and then the third part of this is they ended up in debt as soon as they were, by 30 years old, they all had like 50 grand's worth of debt, or 80 grand's or 100 grand's worth of debt from university. Their parents never had that. So they had everything going against them until crypto came, which is one of the great opportunities. And there's a bunch of other stuff going on in the background as well that I think is going to change this whole dynamic. So I spent a long time thinking about what is going on, seeing the markets go up so fast in the middle of still what the largest recession of our lifetimes and basically of the last 100 years. And I realized that if you divided the S&P or any of these by the Fed balance sheet, they'd gone nowhere. So they were just offsetting the debasement.